you talked about McGraw-Hill transitioning from more becoming like more of a recurring SaaS model,
Uh-huh.
right? So how does that work? Like, are they now charging schools like a monthly subscription to use their textbooks, and then instead of like charging them a one-time fee, or like walk me through that?
Mhm. Yeah, for sure. So instead of like selling the textbooks upfront, getting like an upfront cost, they're instead having like annual contracts with the schools. So providing them a service and not just along with the textbook, not just like the textbook itself, but like associated like homework, quiz, digital learning stuff alongside that. So I think with that whole package, like the annual revenue they get, and the recurring nature of it is definitely more than like what they got initially for like just selling the textbooks. And there's also more operating leverage because the variable cost of like expanding is very low.
Mm-hmm. And it's low because
Because like you already have everything on like the digital web. So adding one more school is just like allowing them to access the information. Whereas traditionally, like you have to print out a whole new textbook, which means like more variable cost.
okay. So if you're looking at a company like McGraw-Hill now,
Mhm.
like as a private equity investor or even just any investor, you're trying to determine if this is a good company or not. Like, what are the main things that you would be looking at?
Like looking at a good investment, for sure.
But
I
like if
think
you're looking at like any type of tech company or even like this ed tech company that has a recurring revenue model versus
uh
like what they used to be, which is more like one time, it's almost like on-prem versus SaaS, let's say, right? Like Microsoft used to just sell you Windows
uh
and charge you like one time versus now they're doing Windows 360 or Windows 365 or whatever, charging a recurring fee. Like, okay, so from McGraw Hill though, like how do I know if this is a good investment or not? Like what are the main things that I would be looking at to make that determination? Like what are the like if these are like the three most important things, let's say, like what would they be?
for sure. I think from a PE investor's perspective, one of the most important things is the TAM of the market and how much market share we're going to get in that, just to kind of see like how much potential growth we could have. And a second really important thing is the rule of 40. So for a lot of software or like tech companies, we want to look at like kind of like a balance between its growth and profitability. So EBITDA margin and the annual growth like added up should be more than 40 to make sure that it's like a good company in terms of its financials. And I think the third thing that's really important is like the deal itself, what multiple you're paying. And 9x on EBITDA is definitely like I think it's a pretty low multiple in the tech space, especially considering its business model and thinking about the potential multiple that you could sell it off like later at
Okay. What if you're not just a PE investor? What about just from like just like a generally like a any general investor point of view?
any general investor.
Like
I think
is this a good business? Like what if you could only look at because like what the answers you gave, like yeah, okay, those are all things that we will look at, sure. But there's like something else that I'm looking for. Like again, the key is you're looking at a subscription business, right?
mhm,
So what are the most important things to look for in a subscription type business? Because quite frankly, like a lot of tech companies are moving to this model, like you said,
okay.
right? So what are like the most important KPIs, let's say, that you would care about?
Mhm. Yeah, I think thinking in terms of this sense, LTV over CAC is a really important ratio to kind of look at just the economics itself of this company. Is it sustainable moving forward in terms of acquiring more customers? And then also looking at the net churn rate. So how many new customers are we getting versus how many are we losing? And if for McGraw Hill specifically, maybe it's better to look at it from an annual standpoint since like the school year is very cyclical versus like it's not like a monthly thing. So looking at it on an annual basis. And then I think the third thing that's really important, again, is like the rule of 40, just kind of striking that balance between growth and profitability.
Okay. Um, how do you like so let's say if I look at this company and I said LTV to CAC is too low,
Mhm.
right? Like what are some things that I could potentially do if I come in as a sponsor and I buy this business? Like what are some things I could potentially do to fix that issue?
Mhm. Yeah, I think we could think about it in two ways. One on the top line denominator, one on the numerator, one on the denominator. And then looking at the numerator for the LTV, I think a really important thing is like lengthening the time span of a customer. So making sure there's lower churn. Also trying to elongate the lifetime. So if it's like a B2C company in the edtech space, not just looking at like high school and college, but expanding it earlier into like the K to 12 space, but also having the service cover like a later area into like professional workforce training. So people use it for like 15, 20 years. And then on the customer acquisition cost side, thinking about are we efficiently allocating our costs in like getting those new customers? How can we better like acquire customers at a cheaper cost? And is every like division of it like profitable and relative to how much we're like spending on getting new customers?
Okay. So um that all makes sense. Is it possible for this business to grow without adding any new customers? Like if let's say like, somehow they are now in all the schools already,
Uh-huh.
right? And they have a like every school is signed up, so they're not going to sign any more new schools. Like, does that mean that they're then tapped out and they can't grow anymore, or can they still continue to grow? And if so, like how?
Mhm. Yeah, I think two main growth drivers, like thinking about the top line. One is like elongating the lifetime value so that even if schools, like we maxed out the number of schools, the schools would use it forever. So just making sure the contracts we look at are like longer term, schools have less churn rate. And that's through building like a really good customer support system, constantly changing our courses and stuff based on their feedback. And the other part of it is having more pricing power. So if we already got to most of the schools, there's a great network effect, everyone's using it. And also like there's a high switching cost to choose like a different provider. We could then start to like hike our costs, the rate we're charging the schools to grow the top line without having to grow the volume.
Okay. Yeah, I mean, you're right. The answer I was kind of looking for is more just talking about the concept of I mean, you mentioned it earlier, net churn, right? So like even if you don't add any new logos or new customer count, if your existing client base is buying more, even like either they're upgrading because they're buying more seats, or like you said, you're raising the price, or sometimes you're not raising the price, but they're moving into a higher, more expensive tier or more expensive package. As long as that uplift is more than offsetting the revenue lost from people who churn or downgrade, then you're still growing, right? Like that's the beauty of a recurring model, is that you don't necessarily have to acquire new clients to be able to grow, right? So I think like long story short, like because you're interviewing for tech banking, like a lot of times people ask, oh, like are there any technology specific technicals that we need to study? Historically, I would say no, because it's not like FIG or it's not like real estate, it's not like oil and gas or some of these other industries where they have like their own set of technical questions. Like the technology industry, they use like all the standard valuation methods, trading transaction comps, DCFs, right? But now as like the SaaS / kind of like recurring revenue business model becomes more and more prevalent, it's I think like you are starting to see, especially with like elite boutiques or like firms like Catalyst, which I think you said you're still trying to go for, like firms like that are very tech focused. Like they now do expect you to know, as I call it, like SaaS finance, right? So for SaaS finance, like yeah, like the gold, like I was trying to steer you towards the LTV to CAC metric, because that is like the gold, that is like the one main KPI that really matters for subscription businesses, right? So you eventually got there, but usually like that would be the first thing that I would be looking at for any business recurring model. How much does it cost to acquire a customer, and how much is each customer worth, right? And then I didn't ask you this, but I assume you already know the answer. Just like, what do you want the LTV to CAC to be at a minimum, which answer is 3, right? And then like knowing the drivers to affect LTV and CAC. So for LTV, I would have said, I mean, some of the things that you said, but I would have been like, yeah, obviously like the price that you charge, your gross margins, which like technically the technical definition of LTV shouldn't just be revenue. You should be using gross margin, right? It's like it's subtracting out the variable cost of delivering that revenue, right? So it's like, what's your gross profit per year, and then like how many years can you keep the customer, which is inversely correlated with churn rate. So like reducing churn rate, like you said, raising prices or reducing cost of goods sold, like those are the LTV inputs. And then CAC is obviously, like you said, sales, marketing expenses, and just kind of how to allocate that more efficiently, right? Or increasing your close rate, that helps with CAC too, right? Training your salespeople to close better, right? Things like that, right? And obviously also knowing that, I think like calling out that like, hey, these two things are sometimes they have dependencies on each other, right? Like I can't just say, oh, I'm just going to raise the price and that's going to increase LTV, but also raising the price is probably going to increase your churn rate, which might actually which might actually end up lowering your LTV, right? Or like raising the price might increase the CAC because now it's harder to sell the product because it's more expensive. So it's more nuanced than that, right? So being able to call out that you understand the interplay between all these variables, I think that is important as well, right? So I think like, and for everyone else that's kind of watching this, like if you're like, what the heck are these guys talking about? And am I supposed to know this? And why is this nowhere in the technical modules and whatever? Like, relax, because you're not going to need to know any of this stuff unless you are specifically interviewing for technology investment banking, and also, quite frankly, like even I would say bulge bracket and middle market tech groups probably wouldn't get this technical on you, but since we're prepping more right now for the Catalyst and Lazards of the world, I could see them going there, right? So this is definitely like way more advanced stuff. So if you have no idea what we're talking about, or you're wondering if you need to know this, like chances are more likely than not, you probably don't. But if you are planning on interviewing for these like top end tech shops, or even like, Goldman TMT or MS Tech, like I know they can get pretty technical too. So then I would say, yeah, like you have to study some of this stuff. And if that's you, like we have resources that we can share with you that walks through kind of all this stuff so that you guys can learn it. It's not hard. And it's actually very interesting.
Hey, if you like this video, click the like button and hit subscribe to get more content like this.